as we come out of lockdown, it seems like the slowdown in activity was less than might have been feared for the UK. Now, as the vaccine program rolls out, we're expecting a good uptick in growth and economic activity, into Q2 and Q3. Sterling's traded quite well, up to nearly the 140 level, and euro sterling's been as low as 85 euro cents earlier in the year. Not expecting a huge amount for the Bank of England today. They don't seem to have an incentive to be overly hawkish until we see the real evidence of the strong vaccine rollout and the improved economic activity come through. But we're bullish on sterling. We like it. We see the real money investors continually coming through to our desks in London and Singapore, wanting to buy sterling in dips. And we're expecting to see that activity to continue over the next month or two.
Right, and I was also asking about the Turkish lira because, given my understanding, inflation in Turkey stands at 17%. The benchmark interest rate right now is at 19%, which means that the real rate is just about 2%. And so it's in a messy situation because there are a lot of challenges ahead economically, and the government is also weighing in on the control over the central bank. How will the currency navigate through all of this?
Yeah, Turkey's in very much a different situation, and there's been a big change of emphasis there in the central bank over recent months. So if you look back to last year, where interest rates nearly doubled, and that was a big supporter for the currency, and there was an understanding that they would remain elevated and support the inflows. There was a change of leadership in the central bank in March, and the market interpreted that correctly as a change in strategy going forward around the Turkish interest rates. And we'd see less hawkishness going, into 2021 and 2022. That's what panned out in the April meeting. Allusions to tighter monetary policy were taking out. Turkey depreciated from around, 7 to 8.4 quite quickly over a couple of months. And we're expecting, if anything, more Turkey weakness from these levels. We think it's preemptive for the central bank to cut interest rates. We don't see them doing that quite yet. That may be towards the end of the year. They've been explicit and tried to calm the market with the idea that they will keep the real rates positive and they will support the current level. But that's not really enough to support inflows at the moment into Turkey. The market had got used to higher interest rates. It'll need higher interest rates to continue to invest at these levels. So we're seeing some more marginal Turkey weakness from this point. I think risk is venting a little bit to the downside if there's a slightly more dovish message from the central bank today, which we're not quite expecting, but it'll definitely be interesting. And we've seen a lot of Turkey volatility the last couple of years and the last couple of weeks. So it's definitely going to be a big focus for us.